Good morning. Today we are discussing about the topic under the financial accounting introduction part. So just you have to listen now. So what do you mean by accounting? Accounting is the art of recording, classifying, and summarizing in a significant manner and the terms of money transaction and events which are the part of list of financial character and interpreting the result thereof. So here we can discuss about the three main concepts: recording and classifying and summarizing. So the recording mean in the terms of the recording, so how much amount the transactions of the financial nature, and the classifies mean which account is to be debit and which account is to be credit with character. And we have to write in the summarizes which account go to the debit concept and which account is to be credit things. And here, the financial terms, the transactions which are measurable in the terms of the monetary terms, only the part of the accounting. So the main thing, the monetary terms, how much the financial information involved in these transactions. The accounting records are maintained in such way that business activities are analyzed and interpreted within the case. The second one, now discuss that objectives of accounting. The first one, systematic and scientific record of the events. The systematic and scientific record of the events mean in the terms of how much the systematical process is there. So which one is the debit and which one is the credit characters, and find out the operational efficiency. So what are the income and expenses inside of the organization? That is the operating part of the accounting process. The next one, the effective control inflow and outflow of the money. So that means how much amount we people are receivable from anybody's and how much amount we can payable from anybody's. The term just you have to identify the income and the inflow and the outflow of the characters, and help the different parties related to the business. The parties related to the business mean like a owner or creditors, investors, employees, government, and the public people, and the research scholars and managers. Now, we are discussed here the bookkeeping. So what do you mean by bookkeeping? Bookkeeping is the art of recording business transaction in a systematic manner. So the objectives of bookkeeping. Bookkeeping provide the permanent record of the each transaction. The transaction means what now? So the transactions mean dealing done in the business. The bookkeeping mean which account is to be debit and which account is to be credit characters. The second one, the soundness of the firm can be assessed from the records of asset and liabilities and a part of particular date. So what you mean by asset? The asset mean the company own assets. Okay, so what are the own assets are there? And the liabilities mean so the amount is paid from outside of the business. So which date, how much the assets values, for example, up to the date. Okay, how much the assets values there, and what about the liabilities to the date of their up to their current date. And the next one, the entries related incomes and expenditure concern facilities to know the profit or loss of given period. So we know very well so how much the incomes and what are the expenses are there. So in the part of the time we know very well how much people are earning the profit, or sometimes people are earning with the loss of the business also. The next one, it enable to prepare a list of customers and suppliers to ascertain the amount of to be received or paid. So what amount the people are receivable and what amount you can payable from anybody's from that. And it is a method of given opportunities to review the business policies and lie to the post of records. That means, so just you have to identify the accounting policies and procedures. The policies and procedures mean so we have to follow the before the things the accounting rules also, the golden rules of the account. So those things also we can follow. Then only we can identify the correct bookkeeping manners. The next one, amended business laws, provisions, license, assessment, and tax, etc. are the based of records. So if you are creating the very good accounting bookkeeping systems, mean it is very we can realize the rightful laws, and it is rightful that taxes. It is based. It is accurately. Is everything's right. Those things also you can consider about that. Now, the branches of accounting we are discussed here. The branches of accounting is divided by mainly three branches there. That is first one, financial accounting. The second one, cost accounting. The third one, management accounting. So it was very simple. The financial accounting. So financial accounting may be defined as the science of art of recording and classifying the business transaction and preparing, summarize the same for the determine the year of profit and loss of the financial position of the company. So we know very simple about that. The financial accounting means to know the profit or loss of the business. So each and every year the businessmen they are collecting the journal entries, and after that they are creating the various ledger account, and finally they are preparing the trial balance. In the trial balance, after completing the trial balance, they are creating the final accounting. Each and every year completed, the people are created, the business people are created, they make a final account. So in the part of the final account, we know very well how much the profit or loss of the financial accounting. The second one, the functions of the financial accounting. So here also it is very simple, the same thing. The recording information. The next one, the classification of data. The making summarizes. The next one, dealing with the financial transaction and interpreting the financial information, communicating the result, and making information more reliable. So here the transaction, the recording the information. So we people are identified easily the art of the recording business transaction, which account is to be debit and which account is to be credit. And here the classifications of the data. So the classifications of data mean we know the types of accounts. After that, what are the types of account involved this business transactions? Sometimes it is considered about the personal, sometimes you can consider about the real, and sometimes people are considered about the nominal. So what are the classifications of data there, the accounts data there? The next one, the making summarizes. The transaction which will be a very big one. So just you can write it like in a small justify about that. The making the summarizes the concept now. The next one, the dealing with the financial transaction. What amount you can payable from the debit area and how much is going on the credit things, and interpreting the financial information. So we people are clearly right about that financial information. What are the financial concepts and the financial information are there. The next one, the communicating the result. The communicating results mean which account is to be debit and which account is to be with credit character. And the next one, make informations more reliable the character. It is right or not. That is main thing. And the limitations of the financial accounting. So here it is a historical nature because it is the past records are there. Okay, that is olden records. What is going on the previous year and what was going on the last month. So there is historical nature we can follow. There is a limitations of the problems of the first problem here. The second one, the provide information about the concerns as a whole. Okay, so if people are look about the financial statement, mean it all the information is involved like in a total concern company values. Okay, it's not helpful the price fixation. We can't fix the right price value of the financial character, and the cost control is not possible. Oh, it is an app. It is an app. The expense is an app. That one we can't be able to possible. It is fixed the cost value. The next one, the appraisal of policy is not possible. Sometimes nowadays they can changing the accounting rules and regulations and policies and procedure. It will be updating every day. Okay, then only it is right concept. And the next one, the only the only actual cost recorded. Okay, so what is going on that the right answers only we people are updated. We here we can't changing anything the things. Okay, so that is the only actual cost. What is the right price of today? Okay, so that concept only is the entering. They're not help in taking the strategy decision making. The strategy means like depends upon the future. We want to protect that value. Okay, for example, today the 5 rupees worth of the product, and tomorrow it is going on 10 rupees. We can't predict it is 10 or 8 or 4 or something. The next one, then changes of manipulation. Sometimes the changes, the fluctuation period, the periodical period, it is automatically, we can accurate that the next year we are adding the net profit value, for example, the 10,000. But it is not that one. So changes in the manipulation. Sometimes it will be going on that 15,000, other it is going on that 8,000. Now the second one, the branches of accounting, cost accounting. The cost mean so how much the price of the product. Okay, so the how much the price of the product mean before we can think about that the cost accounting it is full correlated with the manufacturing value. So here, the cost accounting is the classifying, recording, and appropriate allocation of expenditure for the determination of cost on product or services, and for the presentations of suitability, arrange the data for the purpose of control and guidance of the management. So the cost accounting is very simple. It is manufacturing cost of the product. How much people are manufacturing the product cost and the labor cost. For example, the material cost, labor cost, and what are the expenses there. So how much people are involving the manufacturing process. The next one, the management accounting. It is very simple. We can take in some good decision making about the management. Okay, so the study about the managerial aspect of accounting, management accounting is a concern with the accounting information that's useful for the management. For example, the decision making. For example, the last 3 years we will identify the loss of the business. So what good decision making we can under to the concern now. Okay, and here you can updating the standard costing value and the budgetary control and cash budgets also we can involving in the manage under part of the management accounting process. And here the characters of the management accounting, providing accounting information and causes and effect analysis. The next one, the use of special technique and the concept, and taking important decisions and achieving of objectives, and no fixed norms followed, increasing the efficiency. Suppliers informations are not decisions. And the next one, concern with the forecasting. And here, the methods of accounting. The methods of accounting is divided by mainly two characters. That is, first one, the single entry system, and the second one is double entry system. And we can follow the double entry system. Most of the people are failure in the single entry system because of it is not incomplete system in the record of the business transaction. Sometimes it is only involved in the cash book. Otherwise, you can identify it like in a personal or debtors and creditors something. So the business organization maintain only for the cash book. Maintain the cash book only we can follow in the single entry data. So it is not suitable for any other it's in all the business. Okay. So, and the double entry, it was very best because we can identify that equal things, the debit and credit values are there. For example, the which account is to be debit and which account is to be credit. For example, the cash account debit and current account is credit. So who give the money and who's the receiver and who's the giver, the detail just you can identify. So that way the double entry system is very much important to the accounting area. So the record of the effect of transactions and other events, at least two account is the help equal the debit and credit characters. Now, the types and rules of account. So here I am explained the first one, the golden rules of accounts are there. So here the types of account, the types of accounts mainly divided by mainly three parts. There is first one, personal account. The personal accounts mean accounts which are related within the human beings or companies. Okay, so the companies and the human beings. Okay, the accounts of persons, the who the business deals. Okay, the accounts, the persons who with the business deals. It's very simple. The personal accounts, once again repeat now, the personal accounts which are related with the human beings or companies. Okay, accounts which are related with the human beings or companies is called this personal account. So here the personal account role, debit the receiver, credit the giver. Okay, so the person receive the money mean the person's account is going to debit side. The person give the money to the business side mean the person's going to the credit side. So that is the rule of the first one. Okay, the personal account, accounts which are related to the human beings or companies is called as personal account. So here we can identify that debit the receiver, credit the giver. The second one, real account. Accounts which are related within the company assets. The company assets. The term is called as real account. Here, this accounts consistent of all the assets. It is included like examples like a cash account, furniture account, building account, goodwill, and patents, patent on copyrights, etc. So here the rules, just you have identified the rules. Debit, what comes inside debit and what goes out is credit. Okay. So once again, repeat now the real account, accounts which are related within a company asset. The assets, it is examples like cash account, furniture account, and goodwill account, patent account, and copyrights, etc. So here the rule, just you can identify what comes inside. The asset is came to inside mean it was debit. That is the asset is going to outside mean it was credit now. And the next one, the nominal account. The nominal accounts mean all the expenses and losses and incomes and gains. Okay, the accounts involved all the expenses and losses. Okay, so accounts which are involved in all the expenses and losses and income and gains is called as nominal account. Okay, so here the rules, um, debit all the expenses and losses debit and all the income and gains mean credit. Okay, all the expenses or losses mean we can identify the debit side. For example, the rent paid. Rent is a nominal account, commission is nominal account, interest is nominal account, discount is nominal account. So in the part of the rent paid, example, the rent paid. Here, the rent paid mean rent is your expense. Rent paid mean the payment, the cash is paid. Okay, so the cash is paid, that's your expenses. So the rent account is debit now. Okay, so this concept just you can identify, that is rules and types also. And next one, the accounting concept and the convention. So accounting concept and convention means very simple. The first one, business entity concept. The business entity concept means a businessman is a group of person to achieve an economic objective. Okay, the entity concept relieves the entity represent the group of persons separate and different from the ownership. Okay, here the entity may the part of the business concerns, that mean the departments or branch or subsidiary or holding the company depending on the user needs. Okay, business entity. So accounts mean we need about the business, what's going on that. Okay, what's going on there. The business is not there mean we can't also consider about the accounts is not there. Okay, the next one is going concern. The going concerns mean it is explain the business concern within the future. Okay, it is what's going on, going on. Accounting is not finished now, it is going on the future basis. Okay, it is going on that updating. Okay, the updating level. So here the assumption of the going concern, the business concern has been the perpetual life and assets and liabilities are valid the basis their own and basis of their market value, and by calculating the depreciation historical cost and fixed cost method using the entry life. The next one is money measurement. The account means we need about the money. Okay, all the transactions involved in the terms of money. All the transaction is measurable in the terms of the money or recorded in accounts. For example, the quality of the product and value of efficient workforce, sales policies and conflict within the union and working conditions, etc. But we need about in the terms of the money. So what about the value? Okay, the value, that is money measurement concept. The next one is cost to concept, the cost. So the cost concept is very simple. So the cost concept is the cost concept relates the price of purchases of asset, that is of subsequent accounting for the asset. The assets are recorded the cost price. Okay, is any changes of the market value and assets cost of the time not considered in the accounts of records. Now the next one, dual aspect. Dual aspect mean it's very simple. The basic accounting concept, dual aspect, recording concept and every transaction is the double dual aspect is there. The effect of the dual aspect concept is total asset and total liabilities always equal. Okay, the dual aspect. Okay, debit and credit value is always equal. Otherwise, it's going on the asset and liabilities. It is always equal value to there. The next one is realization. The realizations mean accounting principles on the realization concept, just like in a revenue treated to earn the time when it is realized. The terms of realization refer the legal liability to repay the buyer. Okay, and the revenue recognitions concept basic that assess time and incomes relating to and the accounting period. The next one, the accounting period concept. Accounting periods mean this is very simple. Normally it was going on that 1 year. Okay, the 365 days. Accounting period concept basically dividing the expenditure into the capital and revenue. All the expenses whose benefit come to within the accounting period or revenue expenses. All the incomes are relating to the period revenue incomes. Then basically the accounting period concept is becomes the customary to finalize the accounts once every 12 months. That means I told already the 365 days, the 1 year. Okay, which help to the measurement of the performance of in the terms of the profit or loss. That means it is the accounting period is making at least 1 year. The next one, the revenue match concept. The revenue match concept means
that matching concept. Sometimes the people are identified like in a profit, otherwise you can identify like a loss. But the main aim of the business to make a profit. The profit are calculated by the accounts matching the revenue earned by during the period within the expenditure record. Okay, and here the conventions divided by mainly four characters. That is first one, consistency. Okay, consistency. Conventions of consistency. As it's very simple, the convention of consistency. The nature of the recording business structure should not be changed any course of the movement. It should be the maintained that throughout the lifetime of the firm. The next one, the disclosure. The disclosures mean according to the conventions to enter the status of the firm should be presented to detail without controlling anything. The firm has furnished the record information to the various parties involved in the process of the firm. For example, the employer, employees, owner, each and every people are check the account. It is not closed about the account. Disclosure means everyone we can see about the details. The next one, conservation. So conservatism. The conservatisms mean conventions to the conservatism will not give the any emphasis the anticipating of the firm. Instead, they give permanent importance to all the possible of the firm without considering the future. Conservatism policies to take the considerations of prospective losses, but not the consider the prospective profit. That the last one, conventions of materiality. Okay, so in the terms of mean the relative, all the record information should be provided according statements. Uh, for example, the dropout and the merged and the information, and for example, the terms of the materiality mean, example, all, an item should be regarded the materials is therefore based and believe the knowledge it would influence of the decision inform the investor. For example, the test of the materiality, like three factors, the information, amount, and procedures. Then accounting records. The accounting records mean we can identify the basic things. Four concepts is there. There is first one, journal, ledger, trial balance, and the final account. So each and every businessman, first of all, they are creating like a journal entry. The journal means the record of business transaction. Uh, for example, that is daily recorded. This is a simple book of chronological order. The journal means the record of business transaction, which account is to be debit and which account is to be credit. Okay. So before the journal, first of all, we can learn the types and rules of accounts. Then only it is very simple to do the journal. Okay, because of steps of journal entry, we can identify the three step. The first of all, each and every business transaction affected two accounts. First of all, we can identify the two which account involved this transaction and whether it is personal or real, otherwise like a nominal. Then third, we can apply the must. You can apply the must to the rules of account, which account is to be debit and which account is to be credit. So once again, repeat now. The journal means the record of business transaction, which account is to be debit and which account is to be credit. The time is called as journal. So here the format is there, the date column and the particulars. So which account is debit and which account the things you can write, and ledger portfolio page is there, and debit how much the amount and credit how much the amount is there. And the ledger means like a group of account involved in this transaction. For example, just like a personal account and real account and nominal account. So the ledger is collection of the all the accounts debited or credited in the general journal or various special journal. It means the classifying the transactions according to the type of account. So it's divided by mainly two parts, that is the debit side and the credit side. So here the debit side also we can identify the date column and the particulars and the, which account is paid there, and the ledger portfolio column and the amount column also is there. And the credit side also the same procedure, the date and the particulars and the journal portfolio and the amount. The next one, trial balance. The trial balance is like a statement, it's not like a calculation. After completing the ledger, we can collect the ledger balances. We can create it like a trial balance. Here, the trial balance is a statement containing the balance of all the accounts as a any given date arranged in the form of the debit and credit columns placed by side before the object of checking the arithmetical accuracy of ledger position. Okay, so it is a statement. The finally we can tally the both sides, the debit and credit side is equal value. And the future, the trial balance is prepared the specified date. It's not the specified date. It contains the list of all the ledger account, including a cash account. It may be the prepared with the balance of total of ledger account and total debit and credit columns or the trial balance must tally. It is equal. And if the debit and credit amounts are equal, we assume that ledger accounts we are arithmetical accurate. In differentiate the debit and credit columns points out of the mistakes have been committed and the tallying of trail balance is not conclusive the profit of accuracy of the accounts. Then here the format is there, the trail balance consists of debit side, all the direct expenses and indirect expenses and assets debit side, and the credit side direct income and direct income and indirect income, and the liabilities also the credit side part.